Almost every client we work with has at least one investment they made before becoming a client that they would evaluate very differently today. What's interesting is that almost without exception, they don't describe those investments as illegal or fraudulent or obviously reckless. They describe them as reasonable decisions that felt justified at the time, but uncomfortable in hindsight. Decisions that seemed sophisticated on paper, but fragile once you really looked at them. The most expensive lessons we see are rarely market losses, they're diligence mistakes, quiet ones, the kind that don't announce themselves when capital is deployed, but sit there patiently, waiting for the moment when assumptions are tested instead of accepted. What usually went wrong wasn't intent, it wasn't intelligence. It was that no one ever slowed down long enough to explain what actually mattered. Most of these investors were shown exactly how much tax they could save. They were shown when the deduction would show up. They were shown how much income it would offset. What they weren't shown was how the deal itself worked. They weren't shown why the tax benefit existed in the first place, or what specific facts had to remain true for that benefit to hold up over time. And they certainly weren't shown what would cause the whole thing to unravel if the structure were ever examined closely. That gap matters, because the people who fall into it aren't naive. They're often very good at making money. They're doctors, executives, business owners, people who have spent years mastering their craft, but they've been trained to optimize for outcomes, not for structure. They're used to evaluating results, income, returns, efficiency, and when they're presented with a deal that promises efficiency, especially tax efficiency, their instinct is to assess the size of the benefit, not the mechanics behind it. The problem is that tax advantage investing doesn't work that way. The tax code isn't a neutral referee that simply tallies results. It's an incentive system. It has a point of view. It rewards certain behaviors and punishes others, regardless of how reasonable the outcome might seem. It consistently favors ownership, capital at risk, long-term commitment, and real economic activity. And it consistently disfavors certainty, immediacy, and purely financial engineering. That isn't political, it's structural. The tax code doesn't care how smart you are, how successful you've been, or how compelling the story sounds. It cares about what actually happened. It cares about where risk lived, who controlled the activity, and whether profit existed independent of the tax result. Once you understand that, a pattern starts to emerge. The deals that tend to fail aren't the ones where the investment underperformed. They're the ones where the tax benefit was the investment, where the economics were thin, back-ended, or speculative, but the deduction was immediate and concrete. In those cases, the tax benefit wasn't enhancing a real business, it was justifying one. That's the line between tax planning and tax engineering, and it's a line that gets crossed far more often than people realize. Tax planning starts with a real activity that carries real risk, and the tax benefit is a byproduct of that activity. Tax engineering starts with a desired tax outcome, and then tries to reverse engineer a structure that can support it. On the surface, those two approaches can look identical. Under scrutiny, they behave very differently. A simple way to see the difference is to ask a question most investors are never encouraged to ask. If the tax benefit disappeared tomorrow, if the law changed or an assumption failed, would this still be a rational investment? Not a perfect one, not a guaranteed one, just rational. If the honest answer is no, then what you're looking at isn't really an investment, it's a tax position. And tax positions that depend on everything going right don't age well. This is where the idea of substance over form becomes unavoidable. The IRS doesn't care what a deal is called, how polished the documents are, or how many professionals touched it along the way. It cares about economic reality. It cares about whether value was created or merely assigned, whether risk was actually born or simply described, and whether the activity being reported reflects what actually occurred. We've seen deals with immaculate paperwork collapse because the underlying facts didn't support the narrative. Appraisals looked defensible until the assumptions behind them were examined. Legal opinions read cleanly until the structure was tested against reality. What failed wasn't compliance in the abstract, it was substance. So when people ask why smart, successful investors still get burned by tax advantage deals, the answer isn't that they weren't careful enough. It's that they were careful in the wrong way. They were taught to ask how much tax a deal saved instead of why it saved tax at all. They were taught to trust documentation instead of interrogating incentives. They assumed that sophistication was embedded in the structure itself, rather than in the understanding of it. Once that framework changes, everything else changes with it. Deals that once felt compelling become easy to filter, not because they're obviously bad, but because they're obviously fragile. And deals that hold up do so for a very simple reason. They make sense even before you layer the tax benefit on top. That's the shift this series is meant to create. Not fear, not cynicism, just clarity. In the next video, We're going to look directly at the structural fault lines where these deals most often break, related party transactions, valuation loops, sponsor incentives, and the quiet ways risk gets shifted without being acknowledged. Not to argue against tax-advantaged investing, but to show you how to recognize when you're looking at real ownership versus manufactured advantage. Because the strongest tax strategies survive for one reason: they're real investments with real economics.